Okay. Hello, everyone. Let me stop that music. Hello, this is me, Guillaume. I'm the founder of Panoptic. We do these trading shows quite frequently, multiple times a week, and currently everyone seems to be traveling. So we're gonna be kind of doing this on just me and with the audience. I just want to have the audience see how I trade, how I manage my own portfolio. We'll go over the details. Typically, we do it with Rosalie and or Izzy. This is maybe more of a beginner's class most weeks, but today may be more advanced. This is kind of where you can see a bit more closely how I think, how I see these positions that I have. Again, I'm a Canadian citizen, so rest assured, I can access the website. I'm the founder as well. But then, yeah, if you're from the US or you use this, it's not financial advice, but just a way for us, the team at Panoptic, to discuss trades, and people kind of can learn from that. Take it as you wish. It's not, we're not any type of advisors. We're just here for the content. We can get started like we typically do. There's been a lot of movement over the past few hours, even on Bitcoin, and we can go over that where Bitcoin almost hit 110,000. I don't know if they did. 109 was the new all-time high. A lot of folks are excited about these new highs. This is kind of, oh, let me shove my face out of here. All right, this is the content. This is, let's do it this way. Yeah, this is how Bitcoin looks over the past few days, few hours. Definitely something going on. All-time high. This is always fun to see. I have a few positions on Bitcoin as well, but the ETH is also what I look for a lot more. I guess my trading is in LP positions, ETH token, ETH USDC, ETH BTC even. So ETH is also kind of what I'm seeing. We don't see the same upside on ETH. So definitely something that is a bit more localized for Bitcoin, less so than what we see typically where all of crypto goes up at the same time. So ETH has been stable, definitely being stable over the past few days since the big move we've seen. Similarly to most digital assets, no one seems to be going up. It's definitely Bitcoin driven. So this is interesting to see. Maybe a more kind of a institutional inflow or something that is due to larger players getting some Bitcoin. But yeah, this is kind of the lay of the land. We can jump to my portfolio again. Maybe I'm doxing myself, but I don't care. Uh, on the This is me. You can spy on me, or you can have your own portfolio be shown there. But this is the view that we see on the Panoptic interface. If you connect, I like to see this again. When you go to app.panoptic.xyz, we show this for everyone. You might see the notification at the bottom that says that you're, for me, bad jurisdiction. But now we do see this. So I like to see all the trades that have been happening. Burnton calls these force exercises, from the intern, is something that we see as well quite a bit. But yeah, this is kind of the first. What I want to see is how are people trading. This is a weird, I guess, ratio spread. But some people are buying puts, some people are selling puts. You have a lay of the land of the current trades. I also look at the current IV on a lot of these markets. We use IV from the Uniswap pool or your Uniswap specific IV, which is different than realized volatility. It's different than what you have on Deribit. Most of the time, IV is a bit lower on Uniswap, but then it does spike a lot more aggressively when there is a price move. So for now, I would say that this is probably around what we have on Deribit. So there's nothing kind of interesting to see. But BTC, yeah, the BTC ETH is kind of high actually. Let's have a quick look. So even we have an overview. I also look at the different markets. Um, I have a few small deposits there, but what I like to see is the IV, but also the IV percentile. Again, 50% on the ratio. They are very correlated. But I would imagine that the recent move we're seeing in Bitcoin increases the volatility a little bit. And that's kind of one thing that is interesting to see. Maybe we can go to this portfolio right away. When we land on the markets page, we show the Panoptic owned liquidity. We can toggle the Uniswap specific liquidity. There's a tiny purple line. This is Panoptic, but Panoptic liquidity is deployed as options being sold. They have different kind of entry points than Uniswap LP positions, but we do have a lot of liquidity on Uniswap. Um, on that page, we also show the whole portfolio P&L for my position. So currently at the bottom, I see I have two positions, two straddles. I like to be delta neutral. You can swap here. I'm not going to go to USDC, but I can see that both of them are making a bit of money overall, up $175 on my portfolio. You can see here where I'm sitting at some green. So this is the total P&L for the whole portfolio. It includes the current positions and also the premia that's been accumulated. One thing that might be useful as well is that you can do include deposits. This shifts this a little bit. It's up to you how you want to track this, but currently I have some BTC deposited, some ETH deposited as well. The toggle here means do I include my ETH deposits or not in that P&L? And in that case, that's because also BTC is the numeraire, but it does change a little bit, but I'm also kind of comfortable, nothing earth shattering. So this is what I do where I look at the overall market, maybe a few trades if there's anything that pops out, but I look at the overall markets, the IV, the volume, the liquidity. Then on the markets page, I look at my own trades, which could be, in that case, do I see green? Do I see some money being accumulated? And I see the whole portfolio. I could imagine if the price was all the way out there, then I would be worried. But again, I'm in the green, nothing to worry about. The next thing that I do, which is kind of maybe on the more advanced side, these two positions are two straddles. These two positions are supposed to be delta neutral. We show a lot of information about the delta is the next thing I narrow down, which is what is the delta of that position? In that case, it's negative zero point 0.1 or negative 10% for the first position. The second one is negative 49% for the second position. We show this in percent. So if I were to be out of range completely, I'll be negative 100% or positive 100%, depending on which way it goes. Here it's negative 49%. So I can see even from that delta number that I might be uh, off from the central point. And let's click on this to have a look. And if I do this, so this is a position that I've opened quite a while ago. It stayed in range. I'm almost back to where I was. And maybe I'll zoom in so that I'm looking at the live stream. Bigger numbers. This position I've opened, it's the ETH BTC ratio. Remember, the ratio behaves a bit differently than the price, but it was open when the ratio was about 0.024, 23. Now it's a bit higher. So if you look at the delta that I'm in the negative territory, or it's negative. It's not that far from my starting point. I was kind of bearish a little bit when I minted this. It stayed in range the whole time. I'm not worried. This is the portfolio, the fee accrual over time. This is also going up constantly, so there's nothing to worry about. I would expect this spike in premium might be a crash. This was in April. Another spike here, which might be the certain increase that we've seen. But what I'm most interested in is to see that the whole thing is still in range, which it is. So again, even though I'm a bit negative, nothing to worry about. What I like to see is that here there's a V go to V number. This is the multiplier on that position. This one has to be more than one for me to be happy and comfortable with it. In that case, the put side is 1.29, call side is 1, but on net I'm getting kind of 1.4. For what does that mean is that this put option, these are my two positions. There's a tiny kind of purple check mark, but these are my two positions. The call leg, I'm selling 0.25 ETH worth of calls. It's only mean that and that strike, nothing else happens. I'm earning 100% of the fees on Uniswap. The put side now, I'm selling 0.005 BTC. Someone else is selling also a bit more, 0.08. So there's two sellers in that position, but two extra people that have negative balances. And these negative balances mean that they are buying an option. So this is a put option. This user is buying one put, and then 0.04 of that. This other user is buying a straddle. Both of them are long volatility. You want to see a lot of price move. So that means that even though me and the other user are selling 0.013 BTC worth of put liquidity, more than half of it has been purchased away. And that means that now the buyers are paying more, the sellers are receiving more. On average, as I said, this one leg earns almost 30% more than Uniswap because I have two legs. It's actually 15% more together because one has zero. But this is also another kind of one of those trades where the delta doesn't worry me too much. I'm still close to my starting point. I might still be even bearish still because I'm sure the certain price move has made it even more profitable for me. If I were closer to my max, because this has been open for 2 months, a long time, never had to manage it, so I'm happy with keeping it on. Maybe if the ratio were to go down a little bit more, and I hit my max profit, which would be when I manage this. But this is not a trade that I'm worried about, which is kind of just staying there, uh, earning fees, being in range. That's one position. We can look at the other one. Or maybe we'll go this way. The other one, which is the other straddle that I had, this one also has a very, very neutral delta, if you remember, negative 10%. It's actually very, very neutral. Let's have a quick look on this one. This one has been open for a bit longer and that's earned about twice as much fees, but I think that's because the size is also twice as big. But this is another option, which is call a straddle, two legs all on one on top of the other. In that case, I'm also very close to my starting point. I'm also earning fees the whole way, which is what I like to see. So I'm also in the neutral zone. This is actually quite close to my max profit. I might even close this and get the premium and also the directionality, which was a bit fine. One thing as well is that this is on this one, the call side has been purchased. So I can look at the call liquidity. Put is untouched. I'm the only one selling there, but the call side, I'm selling zero point 0.3 ETH. Two people are buying. This is the same strategy as the other one. Someone is buying a call. So in that leg as well, I am earning more fees. In that case, almost 40% more, 1.3 times. And that means that that position, which is on Panoptic, earns 19% more than the same exact one I would have created on Uniswap. And this might be, I mean, I don't think the ratio is going to move too much. So I'm actually fine with keeping this on. I'm still maybe neutral on the ratio. We've seen just today Bitcoin's going up, but maybe the ETH is going to follow. So there's nothing, again, that makes me worried. So I'm going to keep this on. And yeah, so these are the two positions that I have on Bitcoin. Quite long, 2 months, but that's because the price has been favorably moving. Nothing has made me out of range. Nothing has me worried, and that's kind of an easy kind of let's wait and see. One thing that is also on the trade on the markets page, the risk analysis tab here. This is actually a very very important number or quantity that I look at. I look at again the whole market. I look at the individual trades that are done by other traders. I look at my own trades. And finally, I kind of know internally, but I look at the risk tab. This risk tab tells me where am I going to get liquidated. Liquidations are part of the way that Panoptic works. There's a leverage component, there's a borrower component. In that specific case, I see the red line is the required collateral as a function of price. And the green line is just what's the value of my collateral as a function of price. And interestingly, when the two cross, you get to a point where we would say your required balance is higher than your collateral deposits. In that case, you get liquidated. So on the upside, I have risk. On the downside, I have risks as well. The price, liquidation price is 0.015, so about maybe 40% lower on the downside when I get liquidated, and almost 2x, I mean more than 2x on the upside, I also get liquidated. So in that case, it's actually also not something that worries me. I have a good idea of what the liquidation prices are. If I were fully collateralized, I would not have any liquidation risks. Now I'm mainly using my margin, and we can see here from that page that the margin utilization is 58%. That's also something that I'm comfortable handling. So borrowing more money, almost, I mean, a little bit more than 2x leverage on my positions, but the liquidation prices are, at least for Bitcoin ETH, something manageable. So I'm not worried about that. So this position, this portfolio has been working well for me. I've earned, in that case, yeah, we can look in cash, a little bit more than $175 on $1,000 deposits in 2 months. This is actually pretty good. ETH BTC has moved quite in agreement, so being neutral on that trade helps me. So I'm happy with this. And maybe if you have questions too, don't feel free to maybe post them. I think I'll see them on Restream. But that's the ETH BTC. I also have positions on the ETH USDC. This one is also a bit more interesting. I like to trade it a bit more. I have more positions open, more deposits. In that case as well, right? I don't want to scare the children, I guess, if I use Tom Sosnoff's ID, but there's 1, 2, 3, 4, 11 positions in that portfolio, right? So I'm depositing some funds. I'm creating 11 positions. People may say, are you crazy? 11 LP positions? I have trouble managing one. But that's the idea. I have multiple positions opened at different times, open under different conditions, all within a sizable, like a small fraction of the whole portfolio. And some of them have longer time scales, some of them have shorter time scales. We'll try to go over the most kind of the most important ones, but it's me reacting every day to the market. Like this one's open yesterday, 3 days ago, 9 days ago, 3 days, 11 days, 97 days ago. This is interesting. 14 days. So I'm always rolling these positions. I'm always trying to get the best out of each of these. In that case, these positions are ahead. Again, $2,900. Most of them are in the green. One is in the red, but it's not by much. It's actually been helpful. This was worked a bit late earlier. So that's another one where from my portfolio page, I don't look at this that much because I have a lot of ETH and BTC collateral, and the price dictates the P&L. So I don't look at this as much as the P&L of that position, but also the utilization. So what I like to see is I'm below the utilization that we see, 43%. I would get liquidated at 100%. So I'm far from that. Same thing with this 58, 43. I'm good. So what I do next is typically I go to the click here on the markets page to look again at my positions, my whole portfolio, P&L, the risk analysis tab, and everything. So this is again the ETH USDC pool. We have some Uniswap liquidity, very well deployed. I like it. Some Panoptic, we see something make a dent, but this is the Uniswap liquidity. The Ivy is 70% on the high side of the Ivy percentile, and definitely something that could be a good signal for opening a new position. I like to see Ivy percentile spike or even Ivy rank spike. That means that the liquidity is not missing, but misplaced. If there's a huge move to the downside, you can imagine having millions of dollars worth of liquidity at the current price. It goes back to maybe few millions or even hundreds of thousands. That adds to the slippage liquidity, so the volatility. So that's something I look at. But yeah, this one is on the high side. Unlike the every percentile, maybe I'll open a position. This is my whole position portfolio, my whole portfolio P&L. It's also pretty good. I don't know if it shows well, but on the tooltip, when I hover, there is a few quantities, but we have, again, about 2,800 of P&L, but we also have the deltas and the gamma value as well. So my whole portfolio, 11 positions, all different legs. Some of them are long, some are short. The whole thing combines to a single P&L chart. And that P&L chart shows me that the at the money delta pretty much flat, -1 ETH on what is about, I don't know, 50 ETH worth of capital deployed. So less than 5, maybe less than 2% away from neutrality. So I like this a lot. And I see where maybe my break-even points would be if the price were to move right away below 2,200 or right above 30,000 at 3,000. I would be in trouble. Now that's like in the middle. I like this as well. We've shown more recently the gamma value. This is a different value that helps a lot for the whole portfolio. But Here, gamma is 240,000 USDC, or negative 240,000 USDC. Gamma is something that a lot of the quants, or maybe people that aren't experienced, use for managing risk or assessing risks. We show it as well, maybe on the advanced tab, or at least we show it here. Here's how I think about gamma, and this is how you should think of it if you also have some positions. The gamma is the curvature, the risk. It's actually very complex, but the one thing that is useful when thinking of gamma is that it helps you estimate how much fees you would collect over time. Gamma is that measure of risk that is linked to curvature, but this is actually proportional to theta, which is another degree, but theta gives you how much fees you collect per day, per hour, per week, even or per year. So the key relationship between gamma and theta is, or maybe I should write, but it's proportional to one another. It's for the gamma, the theta is proportional to the volatility squared over 2. So volatility squared over 2. If the annual IV is 1 or 100%, then my gamma being 240,000 means that I would earn 1 squared over 2 times gamma, which is 140,000 USDC of premium. If I'm in range the whole time, if I manage to keep my delta neutrality, I would earn 140,000 of theta every year. Or if you do it, it's about 10K a month. This is the best case scenario. This is not to be a guarantee or any, again, financial advice, but this is kind of how gamma should guide your thought process. It's sigma squared over 2 times gamma is your net theta. Now, currently, the IV is 71%, so 71% squared over 2, that's about a quarter. So I would say this times 240. If I look at the current IV, which is not 100%, which is high, but rather 70%, I would expect to earn about a quarter of this, so about 60,000 per year. It's still good, about 5K a month. This is maybe more realistic. But that gamma is both a measure of risk, but also a measure of how much you get compensated for that risk. So again, the key metric you have to keep in mind, if you see a gamma value, similar square root of 2 times that gives you the fees you collect per year, divided by 12 per month, divided by 52 per week, etc. That's also good. So the whole portfolio looks fine. The gamma and theta do the delta and gamma do look fine as well. We can dig a bit deeper on all these positions. And let me start with the oldest one, which also has the highest P&L. Remember, I have 12 positions, but I have different time scales, different management strategies. This one here, this is one that was a bit scary early on, but was fine. This is a yearly straddle. This is a straddle that has a 1-year time scale. And when we talk about time scales in Panoptic, it's linked to its width. How wide is the range of liquidity? That one position has 5 ETH worth of contracts, about, I don't know, $15,000, between 1,400 and 6,300. It's a huge range. Remember, the range tells you about the time scale. This is so huge that on average, you would expect this to be tested after about maybe a year or thereabouts. So this has been open for 3 months. It was indeed tested pretty closely when we hit the 1,500 mark. This recovered nicely, which I like. But for a while, this one was deep in the red as we were testing the 1,500 price mark. Now it recovered almost to where it started. 3 months ago, the price was 2,700. Now it's still 25-ish. I'm back to where I was. The delta of that position is pretty much flat. Zero delta of exposure. I have all the fees that I'm collecting are added on to that position. And I'm earning, again, in that case, quite a bit. Again, I put 15,000. This is a 5 ETH contract. Each leg of that straddle is $15,000, which is what you see on the notional value. So combining these two legs, I have $30,000 worth of liquidity deployed in this huge range, and I'm earning, in that case, 1,800, about 6% after 3 months. You can imagine that to 4 months, it might be, I don't know, 25%, which is, again, what I would expect for me, that wide of a straddle. And it's actually working for me. And remember, this is $30,000 worth of capital. The requirement for that position is only 12,000. So I have a 3x ish leverage on that position. So again, this is LPing on leverage. This is maybe risky for some, or if not most, and that's not something that I would recommend if you're not kind of aware of the risks. But I'm actually okay with that risk. The bulk of the risk seems to be on the upside. You see a lot more kind of red on that side, and that's fine. I would imagine that as this goes on, 3 months in, I'm back to where I was, which is fine. I would imagine that if keeps going up, or if there's some sideways action, that would just keep this on for quite a bit longer. So this one is actually very, very easy to manage. I have to look at it every week, if not every few weeks. And even though it was in the red before, I was still kind of confident in my range of 1500 to 6100 that I was able to keep it on. In that specific case, it paid off because now it's back, and I kind of erased some of these kind of paper losses. Uh, this is the oldest one, earning quite a bit. The bulk of my returns are this for sure. We can look at the one that loses the most, and this one, I can have a look. This was opened a day ago. I remember very precisely. This is a position which has two legs, one put and one call. The put has been out of range for a while. This was 16 to 2080, so it did go out of range very, very suddenly. But that call is still in range, and this call now earns quite a bit. It earns 3x the fees than Uniswap. So back to that multiplier. I'm selling some options here. Two people are buying these calls. These people are deep in the money, if you want, almost earning 1 to 1. It's very, very good for them. The cost of being so close to being in the money and still have me on the other side is that they pay a lot more, 3x the fees. So that one position does earn me 3x the fees than Uniswap. I'm still in range, on and out, in and out. I'm still earning, so I'm not worried about this. But that is one position where I could be in a lot of trouble if the price keeps going up. It doesn't maybe worry me because I'm sizing it small. Again, it's about, I don't know, 1,500 plus 1,300, about 2,500 worth of liquidity at risk. I would lose all of it if it goes to zero. I could lose a lot more if it goes to infinity. But even in that price range, I can eat a loss of a few $100s, even if it keeps going to 3K. So that's another one of those positions where I'm okay with keeping that position on because of that buying activity. If you look at the gamma also, the gamma is 3,300. And then going back to that maybe competition, I would expect that to earn me about $800 per year. It's not much, but it's still fine. Or about, I don't know, 800 divided by 12, about like $60 per month, which is fine. But yeah, this is one that seems to be losing, but because it's size small, because I'm actually not necessarily overextending myself, I'm okay with keeping it on. So at the end of the day, a lot of what I do is trying to be delta neutral, trying to add maybe more positions, which may seem kind of counterintuitive. But if the price moves and all of my positions are in range, but the delta is not what I want to be, I add more positions or reduce the size. But I never kind of fully close my positions out of either fear or kind of non-directionality. I try to manage this by adding a bit more position, reducing my size, but keeping it on. If I have a neutral assumption from 14 days ago, I should trust this and have this be give enough time to realize itself. So there's kind of some multi-dimensional aspect, which is not just the current portfolio, but what we had in the past that guides the management. Speaking of this one, this is another one that is working pretty well. This is, as you can see, a put option. So this is selling a put option. I opened this one 14 days ago when the price was, again, much lower, 1,800. So price did move exactly like I wanted, going up. This is a yearly option. I was so confident that we've hit the bottom that I'm willing to wait till it moves past 3K to make my money, but I'm still earning fees while it's in range. A lot of what I do is short-term neutral, but still have these long-term directional bets. In that case, I did think it was oversold. So I'm making most of my money from the premium, not the premium, but the price move, 9% on that position after 14 days. Might still keep it on. So and this, yeah, might still keep it on. I'm kind of thinking about this a bit more, but Uniswap liquidity provisions or panoptic options, there's one key point which makes them different than regular options. It's that the hey, yeah, someone is on in the chat. Yeah, I'm having a good day. That's right. It's only me, so it's like a live stream from the live stream. If you go on Twitch, maybe I should do it on Twitch. But thanks, Matt. That we've been talking as well on Twitter DMs. Yeah, always open. Yeah, the Gamma, perfect. I like this. Gamma is one of the Greeks. It's actually very, very involved, and you may hear about gamma risk. You may hear about pin risk as well. Gamma risk is impermanent loss. I've said this many times, but gamma is kind of multifaceted. Same way that delta is multifaceted, but gamma for sure gives you a measure of risk. It gives you a measure of how quick your delta changed. This is maybe very technical, and it's the nerd way of thinking about gamma. If you want to see the trader's way of thinking about gamma, which is different, I'm hovering here. I do show the gamma as well, but on that screen, the at the money the money that I have now is negative 1200 USDC. That negative number is hard to interpret, but it's in USDC. Negative 1200. The key thing you have to do is to use that number to convert to theta. And again, theta gives you how much fees you collect per day or per year or per month. So the link between gamma, which is this abstract risk type measure, is a shortcut to compute how much money you'll make, the theta. This is kind of because it's all partial derivatives, you can kind of change all of these definitions, but the gamma definition that you have to maybe know as a trader is the higher your gamma, the more money you'll make in the immediate term. And the amount of money, it's proportional, but negative 1200 or negative $120, if you go down by a factor of 10, you should expect to earn 10 times less. If you go by a factor of 10 up, if my gamma were to be 120,000, that position would earn me 10 more. So it's very, very linear. So that's kind of self-referential. But if you have a gamma at one time, you hope that it's going to keep the same or go up because it's going to tell you about the future earnings. So higher the gamma, definitely higher the risks. But at the more concrete level, it tells you how much fees you collect. And maybe the relationship between the two, 1200 is not how much you'll make. It's a different number. But the relationship between the gamma and how much you'll make is sigma squared over 2. Sigma is the implied volatility. There's always a factor or 2 in there. So if you have a sigma of, in that case, 71%, 71% squared divided by 2, this is about 0.25 or a quarter. Again, 70% is close to square root of 2. So that conversion, maybe that's the best scenario. Each IV is between 60 and 80, maybe 71% is actually a good round number. So maybe also I'll try to see if it makes sense, but a key way to convert between gamma and returns, take gamma and divide by 4. So in that case, regardless of the IV, it's still a rough number, but your gamma is 1200. Divide by 4, it's 300. So that one position, which is a Uniswap LP position deployed to Panoptic, should earn you $300 per year. You take the gamma, divide by 4. And maybe, again, we'll maybe do some back tests, but that might be a very, very easy way. Take the gamma, divide by 4, it gives you the yearly return. So $300 per year, that's $25 per month. This one has been opened for half a month. It earned $18, a bit more, but it's actually ballpark the same way. So take the number that gamma gives you, divide by 4. That's going to give you the yearly. So hopefully that makes sense. That's kind of maybe one way that I will teach Rosie as well, but use it in my own trading is gamma and theta. It's divided by 4. So that one LP position is in range, earning $300 if it stays in range. Of course, there's impermanent loss, there's a price kind of move, but that's kind of how you would earn, how much you would calculate how much it earns. Um, Let me go to maybe another one that might be a larger position. Yeah, this one. So this is, uh, yeah, let's go over that. Let's go, let's do some theta maybe to gamma conversion. This is another of my positions, kind of sizable, I guess, on the higher side of what I'm comfortable with, but that's fine. 2.5 ETH. This is controlling about $15,000 of USDC. Portion requirement is only 3,000, so 5x leverage. It's very, very capital efficient. Uh, I was bullish, I guess, when I minted this. Price went up. That's why I'm making money. I'm earning $40 of gamma of fees in 2 days. This is also pretty good. The maybe target price for this position is 2,900. We'll see if it's true, but again, in a monthly time scale, personally, I think it's true. So that is positive delta. You have a positive slope. This is still in range. This is also in the green. When I minted this, I guess I was the curve was down a little bit, so you had less losses. But that's in that case, it seemed to be very straightforward. So this is good. And let's go do the gamma to theta. Gamma here, it's a shorter dated position, a monthly option. The gamma is, again, remember, I have about $15,000 worth of liquidity in that. The gamma is 30K. Again, 30K, kind of higher, more risk, more reward. In that case, 30K divided by 4, that's about 7,500 per year. 30K divided by 4. So I would expect if this position were to stay in range the whole time for a year, between 2,300 and 3,700. Maybe that's going to happen, like we've seen over the past few years, but 7,500 worth of theta that I would expect to get, and then divided by 12, 600 per month. I earn $40 in 2 days. Again, $40 times 30 divided by 2. It's about 600, right on the money. $40 in 2 days is 600 per month. That gamma to theta, which is 2,800 divided by 4, it's about 75K. Divided by 12 is about 600. So it all kind of matches up. So that position, the theta, the gamma is between 2,700 and 27,000 and 30,000. Again, these may seem like big numbers, but that divide by 4 gives you the expected yearly returns. This is a monthly option, so we divide by 12 again to get the lifetime expected return. So 600 per year, per month if it stays in range. I'm 2 days into, I'm tracking this pretty well. Again, one of those positions that I have opened are definitely on the kind of more recent expectations. Maybe I was wrong because Bitcoin prices has gone up, but not mine, not ETH. But that's another way to look at this. And yeah, okay, so Mad Dead got it. Thanks. So yeah, this is how I will also not even touch this. If the price goes below 2,300, then I'm out of range. I would definitely look to manage this, but otherwise, this looks fine. We can trigger advanced mode. I just realized if you trigger advanced mode, we show the gamma values here. So you can have each legs, 14K per leg together. It's about 30,000, but that's fine. So again, this portfolio is actually the one that I would perhaps close is the 1 year put that was kind of in the money. I'm looking here. One thing that is important is I'm mostly debt neutral. This one position is 0.00, very, very debt neutral. The one thing that is also important is that the spread is also 0. So this is something that, again, as I mean, we've built the interface, so I know what it means. It means that it's actually out of range. If the spread goes to 0, this is 1% that is out of range. So technically, I don't pay anything or get paid anything. Let's see. Again, I know this trade, but let's see what this is actually doing exactly. This was open 2 days ago. I mean, 2 days and a half ago. This is a spread, 2 legs, one long, one short. The way this was created, I mean, I'm a bit opportunistic, but this is buying a daily call option that is way, way, way out of range. So I get this for free, and I'm selling a call option at a wider range at a higher strike. so that my P&L looks like some downside protection. I mean, it may seem big, but the most I can lose for that position is $1,000. The most I can make is $200. However, again, I lose $1,000. That may be seem like a lot, but this position is $20,000 in notional value, or at least $10,000 on the call side. So if I were to not buy this protection, the most I would lose is 10,000. Because I'm buying protection, I only lose 1,000, so I reduce my risk by 90%. I like this. This was a position that was out of range, doing nothing. I take advantage of this person asleep at the switch, so I can actually buy protection. If for some unknown reason price did collapse back to 1,600, then the most I lose is 10%. It's actually very, very manageable. That specific trade was bullish, where I would make the most money, the price going up. It did go up. It did leave my range. This is probably over the past few hours even. I'm out of range, or I'm getting paid nothing. I pay nothing, but this is a good type of position because it worked exactly like I wanted. For me, it is out of range in that flat zone. No more risk, but no more reward. So that would be one that I would definitely close. And maybe I'll do it now. But yeah, I could close this. I don't think it's going to reverse, or at least do much, but I would pocket this $200 in 2 days. Very good. Oh yeah, one last thing. Sometimes I have to look at the gas. This is mainnet. Let's see. Oh yeah, this is the gas currently 10. I'm not in such a hurry to close this position. So I'm gonna keep it on. It's one of those trades where, yes, I'm out of range, but there's no risk. It's flat. What I would do is maybe even create a position with create a transaction with a very low gas price and wait overnight till it fills, which is fine. Or wait till in a few hours. If I do see it going down, I could close manually. This one trade was directional, defined risk. I knew the max losses, netted me 16% in 2 days, did exactly what I wanted. If you look at the gamma number, it's zero. So I'm getting paid zero. Was used to be 50K a lot over the past when it was in range. But yeah, so this is a opportunistic trade that takes advantage of dormant liquidity, reduces my losses, allows me to be directional at the same time. Is it the only one that has zero? Yes, it's the only one that's out of range, but this is fine. Let's look at another one that is maybe the counterpart of this. This is one that is losing. Oh, yes, since we started. This one has started losing. Oh my God, let's see what happens there. This is another spread. This is one where this was bearish. I also purchased a call option. It's still in range, so I'm paying fees, and also sold a call option. This one is buying a monthly option. This monthly option is very wide. I remove a bunch of liquidity that is very wide and concentrated in that call, which is very, very narrow. The premium is negative. Now it's turning, it's positive, turning negative, but this trade was, both of it was directional and also try to harvest a lot of fees in a short amount of time. Remember, this is a monthly option that I buy, but I sell the daily option. This is open for 3 days. Maybe I should have managed this, but this option being 3 days over, again, 2 days over the one daily, means that yes, there could be a reversal. There could be kind of ways for this to go wrong. Price keeps going up. I may lose $200, $300, $260. So I'm a tiny bit loser. Maybe it's also one of those where I'm okay with keeping this only if there's a short time reversal. But in reality, this was a daily trade. I started in range, pretty much in the middle. I think it went back and forth, and then now it's leaving my range, so I'm only paying. Now the gamma, if it's in range of that short call, the gamma is negative. Now that I'm only in range of that long call, my gamma is 5,700, but positives is 5,700. So back to that conversion between gamma and now how much do I pay? 5,700 divided by 4. This is about, I don't know, 1,100, 1,200. I mean, no, more than that, 1,300. So if that position is always in range, I pay 1,300 of fees per year. 1,300 divided by 12 is about $100 per month. It's not allowing me to gain much more. I'm kind of naturally bullish, so that one doesn't serve me much. So I would probably close this. Did earn some fees. Did allow me to be in the red, but by not less. But this is one of those where it might not have worked. Might as well eat that $8 loss. Um, yeah, let's see. Is the ETH price pumping? Yeah, maybe not. But that price move, if we were to revisit 2600, may mean I have a bit more to lose. So this is another one where I can understand what the entry point was, uh, being a bit bearish in the short term, but unfortunately, we're bullish. So this one might be where I close this. So um, yeah, this one is losing. This other one we visited. Let me see if there's anything interesting. I do a lot of these spreads. This is a calendar spread. This is a very, very not advanced, but a very cute trade. Here's another one. Let's see what it look like. Again, remember, I'm losing $30 in one position, $16 in the other position. I'm making more on the other, so it all averages out. So there's never one trade that you have to manage right away. There's always a some margin for error because you're not always if you unless you're trading CODTs, but there's some ways to manage your liquidity if manage your position if you're not always on in front of your computer. Uh, this is another one where let's look at the current delta. Delta is 0.08. Delta is fine. I'm actually neutral. And also I'm earning fees. My gamma is negative 16,000. So I'm earning fees. I'm neutral. This is where I'd like to be. If we look at the price here, I'm defining my risk on the downside. The most I can lose is $450. Capping my upside, the most I can make, $63. It's actually uh, reasonable, pays for gas, but it's not going to make me a millionaire overnight. But that's one of those trades where I'm also buying a wide position and concentrating it to a narrower range. So I started with buying a monthly option, selling the shorter dated weekly option. This creates kind of that concentration trade that I like. This was a bullish trade, almost at my max profit. Started at 2,400 back to 2,600. It's worked perfectly. That one might be where I do collect the fee the wins here. Earn $36 of fees. I earn an extra $60 of price appreciation. One thing I could do is if yeah, I'm paying a bit more. This is the worrisome part. So um, oh, I'm selling and buying myself. So this is very, very incestuous. So I'm not worried. I'm paying more, but I'm paying to myself. But what we have to be careful is that multiplier. Currently, it's 1.49, 50% more than Uniswap. This one is only 1% more. So you pay 50% more on one hand, you get only 1% more. But the beauty is that you concentrate liquidity so that concentrated liquidity, shorter dated, has a lot more power to it, a lot more oomph. And in that case, it's allowing me to be still positive, even though I'm paying on one side, getting paid on the other side. The premium commission is still positive. It's small, 0.2x the fees on Uniswap. I'm earning less. I'm paying for protection on the downside. This is directional, so as long as my direction is right, I make money. But because I'm concentrating, this is also why I like to do these calendar spreads. You concentrate liquidity that's misplaced. You still earn a positive theta, which is what you want. Your gamma is still positive, but you are maybe benefiting from the directionality more than time going by, which is theta. So that one is another one where um, might as well close it. So this is 3 days, 2 days into a weekly / monthly calendar spreads. This has worked for me, so I could realize these wins. There's not much more I could do better instead of waiting. So there's more chance for the market to turn. So that's another one that I'll pretty close. But yeah, so yeah, maybe I'll do one or two more positions. If you have questions, feel free to ask for sure. It's always good to hear about these things. And if you want, again, this is a bit more advanced, but if there's something that unclear, let me know. Yeah, let's see. Another one that is a large um, position size. Oh, yeah, this one. Okay. This one is interesting. This is a delta neutral trade opened 9 days ago. Back to where the price was, interestingly. We started with the price was 2,500. Now it's 2,600. We're heavily negative delta. In that case, the delta is about negative 1.2 ETH. So it's almost out of range for one of the leg. It's not something that is kind of directional wise, not what I wanted to see. This trade, I would say, is not going well, but we're earning fees on both sides, which is fine. And one thing that I can kind of intuit from that is that this was a trade that was optimizing the fees. In that specific case, delta neutral is fine, but you have uh, it's a straddle, which is normal delta neutral, but we do have some deltas to it. But the key point is that it's doubling down on the position sizing. So a put and a call at the same strike. We only count the one try one leg at a time if you want. If you have a put and a call, all getting sold at the same range, the put has risks on the downside, the call has risks on the upside. So you can actually nullify the risk. You only have one risk at a time, so you can get one leg for free, more or less. And this is what the collateral engine works with. So double down on my position sizing, and also chose strikes which have a lot of buying activity or buying demand. That one strike has two people buying, two people selling, so I'm earning in that case 12% more. This is another strike where I'm earning quite a bit more. It seems it's the put side. Yeah, I'm earning about 6% more. So net, I earn 9% more than Uniswap fees, doubling my sizing. So you think of it as 18% more. There's a naked call, naked put. Um, I'm in range, but one of my legs is leaving the range of 2,600. So I'll keep this on. I'm okay. The whole portfolio is flat. So even though this one is losing, another one is winning at the same time. I like the fees. Again, $140 in 9 days. Is the Gamma math working? Gamma is $14,000 divided by 4. It's about 3,500 divided by 12. It's about $300. A bit less than halfway, a bit more than halfway. That's good. Yeah. So this is also another one. So back to that full portfolio page, you can look at your whole portfolio delta. You can look at your whole portfolio gamma as well when this loads. Let's do also some quick math here. I mean, actually, risk analysis. We haven't looked at this. This version has a lot of ETH deposits. This is just me, my stash. But ETH deposits mean that there's likely no risk on the upside. Zero neutral only have risk on the downside, which is this 1150 liquidation price. So mental note, unless we revisit these very, very low prices, I'm not at risk of being liquidated. Even then, if it does go down, I would have to close my positions ahead of time. So that's fine. So back to reverse analysis. I didn't cover this because I knew it was kind of only one-sided. And back to that whole portfolio P&L. Again, remember the oh yeah, okay. This is my whole portfolio P&L. The delta is a bit higher. Negative 2 ETH. It was negative happening earlier. Negative 2 ETH, definitely on the increasing size. My gamma is $190,000. Again, $190,000. It's not the risk, but rather the amount of gamma divided by 4, divided by 12. We expect to earn 4,000 every month. Again, given that I'm seeing range, or maybe 1,000 every week. This is also kind of in a good scenario where I'm flat, I'm earning fees. My goal is to adjust the fees. Now that I see that I'm collecting some negative deltas, maybe I'll sell a put. I'm still way below what I expect to be, which is about 50% utilization. If you listen to even Tasty Trade, they have kind of an easy way to think, but the per portfolio sizing, the larger your portfolio, maybe the lower utilization you want to be. If you're owning $1 million, you may not want to go above 25%. In that case, this is about, I don't know, 100K. So 40% is good. If you have a 10K portfolio, maybe you can venture a bit higher to maybe 60 or 70%. In that case, I may have one or two positions open to allow to neutralize these deltas and have plus 2 ETH. That brings me back to being a positive delta, a neutral delta. But yeah, and then overall, it's just kind of how I manage my portfolio. All right, one last thing that I'm starting to explore a bit more. Um, Puts are cheap. No one is buying puts for some reason. When the price goes down, you would have been definitely on the winning side buying these puts. Uh, what I'm trying here is that I created a straddle, a weekly straddle as well, so a lot more concentrated. But this straddle will make money if it stays between 2,400 and 3,000. This on its own earns fees, double down the capital efficiency. This is a good trade that I would do quite often. This was a bit bullish. I'm making the most money if the price hits 2,700, so it's halfway there. I'm happy with this. But because now a lot of options are out of range, I decided to buy some protection, some peace of mind. I don't think it's likely, but it comes for free, so why not? But if the price were to collapse down, I would cap my losses to $1,800 as opposed to, in that case, I guess, $12,000. So also about again, 85%, 80% decrease in risk. Uh, Maybe I'll do this a bit more because this is a free option. Peace of mind means that I do have limited losses on the way down. It doesn't affect my P&L here because it's out of range, and I still have a healthy and 50k worth of gamma. So it's a weekly option. So 50k divided by 4, it's about 1,200 divided by 50. I mean 50k. It's about 1,000 per week. Is it? I'll have to look, but yeah, $64 up to now in 2 days. Maybe that's it. Yeah, a bit 20 days, it would be 600. So still in range. One thing that again I'm exploring it more is buying protective options. This is a ratio spread. This is also one of the strategies that we preload, but again, unless you know what you're doing, it might be weird to preload this. But this is definitely a protective move. Maybe I don't think it's going to collapse, but if it does, I could get that insurance for free. I'm not worried about price now because of that max loss. If it does shoot up, then I'm exposed, but this is one of those that's neutral. So I'm actually happy with this, earning quite a bit of fees, and it might not be a dumb decision to have this protection built in. So you can buy puts, at shorter dated, longer dated. If it's out of range, you pay nothing for them. This is actually a very, very good place. And they're so far out of the money that buying them on their own, it won't pay. I guess if it was in the money, it's different. But now it's like also if you buy a put on its own, it doesn't do much. It's only when now it's combined with other strikes that you get a little bit more kind of bang for your buck. Again, cost zero. So that's another one that is I'm trying to explore, trying to find ways to buy options for free. Who wouldn't want that? But yeah, again, this is and I'm looking at my own positions. The closed positions is also something that people can look at. I was not as lucky. Everything is green, but if I were to look at my historical positions, a few of them did get tested because of the price moves. I lost again a few $1,000s, but I'm kind of netting periods of green interspersed with periods of deep red. This is how, again, picking pennies in front of Streamroller. But again, for the past month, I was mostly green, bunch of losses because of price move. This is how it happens. So now maybe that's also why I'm a bit more cautious in trying to buy options. This one is a cute one. You can look at my close positions as well, but the I'll probably do this when I do my taxes. But this is another one that was also cute, which is buying options which are mostly out of range, super wide, selling a very, very narrow position, a daily straddle. It has this funny payoff. It still has max losses. It earns a lot when it's in range. Unfortunately, it left the range and it moved further, so I would have lost more. But again, I earned $130 of premia that offsetted, in that case, $180 of price move. So my losses again are cut by more than half. The whole time it was in range. Or maybe not, but yeah. That's another one where it's kind of fun to also relocate liquidity that's been misplaced. All right, so I've been going for a long time. This is hopefully this is going to help you maybe internalize some of these ideas. Again, don't be afraid to be more strategic, have more ongoing strategies. If your whole portfolio is neutral, there's less to worry about than if you're totally directional. I like to get paid by buying options, by selling options and getting the premium. You can buy options and have a similar approach, which is short term bullish, near term bearish. Could be a different way. But yeah, that's just kind of how we. I personally view options trading. I'm happy with that green numbers, but remember, it's going up and down, and we did see a lot of move on the downside, sudden moves on the upside. I'm actually a bit ahead, which I'm proud to say. 2.6% on the USDC, 1.1% on the ETH. So had I done nothing, I would be kind of maybe 0 and 0. So now I'm making a bit more money. A lot of it comes from losses that had been due to these moves. But again, if it stays in range, in the case, if I were to close this, I would add another, I don't know, half an ETH and then also some USDC. So that's also something that's ongoing. So yeah, I think that's it. This was kind of fun. We'll see. This is a little bit more like a Twitch live stream, so people feel free to ask questions, or even on YouTube if you're listening, can actually. Yeah, that's it. Stop losing, start trading. Getting an insight in the founder's portfolio. Hope you like it, and otherwise, again, ask me questions. Everything wasn't clear. I'm looking forward to hearing from you, or follow us on Twitter, join our Discord. You can ask me questions there too. Yeah, that's it. Thanks a lot.